Today, I'm going to show you exactly what's happening to your money right now, why 2026 presents unique challenges that most financial advisors aren't discussing, and most importantly, the only approach that will actually protect and grow your wealth through what's coming. But I need to warn you about something first. The solution I'm going to share isn't what you expect. It's not complicated, it's not trendy, it's not exciting, but it works. It's worked for nearly a century. And it's the same approach that has protected wealth through every crisis in modern history. Stay until the end, because that's where I'll reveal exactly what to do, step by step. Let me start by showing you what's actually happening to your money right now. The average American has approximately $65,000 in savings. In the United Kingdom, the average household has about £17,000 set aside. Most of this money sits in traditional savings accounts, earning somewhere between 4 and 5% interest. That sounds reasonable, until you understand what's really going on. Inflation over the past 4 years has cumulatively exceeded 20% in both America and Britain. That means if you had $100,000 in 2020, the purchasing power of that money has dropped to approximately $80,000 in real terms. You didn't spend it. You didn't invest it badly. You just let it sit there being responsible, and you lost $20,000. Here's what terrifies me about 2026. Central banks are caught in a trap. They raised interest rates aggressively to fight inflation. Now economies are slowing. Growth is weakening. The pressure to cut rates is building. When rates drop, the interest your savings account earns will collapse. But inflation doesn't disappear overnight. You'll be earning 2 or 3% while prices keep rising at 4 or 5%. Your money will be losing purchasing power even faster than it is now. But that's only the first problem. The second one is something almost nobody is talking about. Currency devaluation is accelerating globally. The US dollar has lost over 96% of its purchasing power since the Federal Reserve was created in 1913. The British pound has followed a similar trajectory. This isn't conspiracy. This is mathematics. Governments around the world have taken on unprecedented levels of debt. U.S. national debt has exceeded $34 trillion. UK government debt has surpassed £2.6 trillion. Debt to GDP ratios in most developed nations are at levels that would have been unthinkable a generation ago. When governments have too much debt, history shows they rarely pay it back honestly. Instead, they inflate their way out. They allow the currency to lose value so that the debt becomes easier to manage. Your savings are denominated in those currencies. Every dollar or pound you hold represents a claim on purchasing power. When governments devalue currencies to manage their debt burdens, your savings pay the price. I've watched this happen repeatedly throughout my lifetime. The people who suffered most were always the savers, the responsible ones, the people who did everything right according to conventional wisdom. They held cash, they trusted the system, and they watched their purchasing power evaporate over decades. But 2026 brings an additional challenge that makes this even more dangerous. The global financial system is fragmenting in ways we haven't seen since World War II. Geopolitical tensions between major economic powers are creating uncertainty that ripples through every market. Supply chains that seemed permanent are being restructured. Trading relationships that lasted decades are being questioned. Currency wars are no longer theoretical. They're happening right now. Countries are actively trying to weaken their currencies to gain competitive advantages. When everyone races to devalue, the only losers are people holding those currencies. I'm not telling you this to scare you. I'm telling you this because you need to understand the environment your money exists in. The rules that worked for your parents and grandparents are being rewritten in real time. Keeping your money in a savings account and hoping for the best isn't a strategy. It's a slow-motion disaster waiting to happen. But here's where people make their biggest mistake. And this mistake has cost more wealth than any market crash in history. When people get worried about their savings, they panic. They pull money out of stable investments and chase whatever seems hot at the moment. They buy crypto at the peak. They pile into meme stocks. They fall for promises of incredible returns with no risk. They become exactly the kind of emotional investor that loses money in every market condition. This is not the answer. Panic is never the answer. The solution to protecting your wealth in 2026 isn't about finding some secret investment or timing the market perfectly. It's about understanding timeless principles that have protected wealth through every crisis in modern history. Let me share what actually works. But first, you need to understand why most advice you're hearing right now is wrong. The financial industry profits when you move money around. When you're scared, they sell you products. When you're greedy, they sell you products. When you're confused, they sell you products. Most financial media exists to generate clicks and views, not to actually help you build wealth. That's why you hear contradictory advice constantly. One expert says markets are about to crash. Another says we're entering a massive bull run. One recommends gold. Another says gold is useless. One pushes real estate. Another warns of a housing collapse. This noise serves a purpose. It keeps you engaged, confused, and dependent on their next piece of content. It keeps you trading, which generates commissions. It keeps you anxious, which makes you susceptible to buying whatever solution they're selling. I've watched this cycle repeat for 7 decades. The actors change, the products change. The underlying manipulation remains exactly the same. So let me cut through all of it and tell you what actually protects wealth. What has always protected wealth? What will continue to protect wealth through whatever 2026 brings? The only way to truly save your money isn't a single action. It's a system, a framework, a set of principles applied consistently over time. I'm going to share 4 essential components that must work together. Miss any one of them and the others become less effective. Implement all 4 and you'll be better protected than 95% of people heading into 2026. Here's the first component, and it's the one most people completely overlook. You must spend less than you earn by a significant margin. This sounds almost insultingly simple, but let me show you why it's the foundation everything else depends on. The average American household earning $70,000 annually saves approximately 3 to 4% of their income. That's about $2,000 a year. After accounting for inflation, their savings are essentially flat or negative in real terms. They're on a treadmill going nowhere. Wealthy households operate completely differently. They maintain savings rates of 20, 30, even 50% of their income, regardless of how much they earn. The gap between income and spending isn't something they think about occasionally. It's engineered into their lifestyle permanently. In 2026, this gap becomes even more critical. When economic uncertainty rises, job security decreases. Income streams become less reliable. The people with large gaps between income and spending have options. They can absorb income disruptions. They can take advantage of opportunities that appear during downturns. They have time to make smart decisions instead of desperate ones. The people living paycheck to paycheck have no margin for error. One job loss, one medical emergency, one unexpected expense, and they're in crisis. Before you do anything else, ruthlessly examine your spending. Cut everything that doesn't genuinely improve your life. Redirect that money toward protection and growth. But saving alone isn't enough. The second component determines whether your savings survive inflation. You must own assets that produce real returns above inflation. Cash in a savings account is not an asset. It's a temporary parking spot that's leaking value every day. Real assets are ownership stakes in productive enterprises. When you own shares in a company, you own a piece of a business with employees working every day to create value. You own equipment, inventory, intellectual property, customer relationships. These real assets tend to hold their value and grow even when currencies decline. Consider this. If the dollar loses half its value over the next 20 years, which is entirely possible based on historical trends, the price of everything doubles. A company that sold products for $100 now sells them for $200. Its revenues double in nominal terms. Its profits likely double. Its stock price adjusts accordingly. Your shares, which represent ownership of real productive assets, maintain their purchasing power. Meanwhile, dollars sitting in a savings account simply buy half as much. This is why I've spent my entire career buying ownership stakes in great businesses, not because I predicted any particular crisis, but because ownership of productive assets is the most reliable long-term store of value humanity has ever created. For most people, the simplest way to own productive assets is through low-cost index funds that track broad market indices. You don't need to pick individual stocks. You don't need to follow markets obsessively. You simply need to own pieces of many businesses and hold them through all conditions. But ownership alone doesn't protect you in the short term. The third component addresses what happens when chaos strikes. You must maintain strategic liquidity for opportunities and emergencies. I always keep cash available even though I know it loses purchasing power over time, not because I love holding cash, because cash gives you options when others have none. In every market downturn, the best buying opportunities appear. Great businesses go on sale. Assets that were expensive become affordable. But you can only take advantage if you have available capital. In every personal crisis, cash provides survival time. Job losses, health emergencies, unexpected obligations. These require immediate liquidity that investment accounts can't always provide quickly. I recommend maintaining at least 6 months of essential expenses in highly liquid form, not invested, not tied up in assets that could take months to sell, available immediately. This isn't money you're investing, it's insurance. It's buying power for emergencies and opportunities. It's what allows you to stay calm when everyone else is panicking. Yes, this cash will lose some purchasing power to inflation. That's the cost of security and optionality. It's worth paying. But these three components still aren't complete without the fourth. And this one determines whether everything else actually gets implemented. You must automate everything and remove yourself from the decision-making process. Human beings are terrible at making consistent financial decisions. We're emotional. We're easily influenced. We get tired and distracted. We intend to do the right thing and then don't follow through. Every study of investor behavior shows the same pattern. People buy high and sell low. They chase performance. They panic during downturns. They get greedy during bull runs. They underperform the very investments they hold because they can't sit still. The solution is automation. Set up automatic transfers from your checking account to your investment accounts on the day after you receive income. Choose your investment allocations once, based on principles, not predictions, and then automate the purchases. Create systems that execute your plan regardless of how you feel on any given day. The wealthy don't have superhuman discipline. They have systems that make discipline unnecessary. The money moves before they can talk themselves out of it. The investments happen before emotions can interfere. The plan executes automatically month after month, year after year, decade after decade. So here's your action plan for 2026. First, calculate the exact gap between your income and spending. Find ways to increase that gap by at least 10% immediately. Cut subscriptions you don't use. Reduce housing or transportation costs if possible. Every pound or dollar you free up becomes fuel for protection and growth. Second, open investment accounts if you haven't already. In America, maximize your 401k, especially if you get employer matching. Open and fund a Roth IRA. In Britain, use your full stocks and shares ISA allowance. In Canada, maximize your TFSA. In Australia, consider additional superannuation contributions. Third, choose low-cost index funds that own broad baskets of productive businesses. An S&P 500 fund a total stock market fund, or a global equity fund. Keep it simple. Complexity is the enemy of execution. Fourth, set up automatic transfers, so money moves to investments immediately after every paycheck. Remove yourself from the decision. Let the system do what you designed it to do. Fifth, maintain your emergency fund of 6 months' expenses in accessible savings. Replenish it immediately if you ever need to use it. Watch this video again when markets are falling and you're tempted to panic. Watch it again when some hot investment is promising incredible returns. Let it remind you what actually works. Subscribe to this channel for more content on protecting wealth in uncertain times. Warren Buffett investment strategies, how to beat inflation, building financial security, surviving economic downturns, and achieving financial independence. Whether you're searching for how to save money in 2026, best investments during recession, protecting wealth from inflation, Warren Buffett advice for beginners, or how to build an emergency fund, these principles are your foundation. The storm may come. The storm always comes eventually, but you don't have to be caught unprepared. Build your system now, automate it now, and face whatever comes with the confidence that your money is as protected as it can possibly be. That's how fortunes survive. That's how wealth compounds across decades. And that's exactly what I want for you.